Ladies and gentlemen, let me give you a warm-hearted welcome to today's update call on BB Entrepreneur Europe Small, a Luxembourg-registered UCITS fund with daily NAV. My name is Phil Steiner. I'm with Bellevue Asset Management Zurich. Today is Wednesday, the 13th of May, 2020. Today's update call is with Birgitte Olsen, lead portfolio manager of our BB Entrepreneur Strategies. Birgitte is managing the fund, and she's got 25 years expertise in the professional investment field. Entrepreneurs are owner-operated and family-owned businesses that have demonstrated to be more steadfast and innovative, especially during times of crisis. They do not think in quarters, but in generations instead. The fund is focusing on companies with strong balance sheets and leading market positions in their industries. Subsequently, I'm happy to be able to say Birgitte managed to significantly outperform versus MSCI Europe Small on a year-to-date basis. Having said that, I'm excited to hand over to Birgitte and listen to her firsthand to her insights.
Thank you, Phil, and welcome from my side as well. The title of the update is Strong Balance Sheets, the Best Medicine. Then we believe that too much debt in a situation like the crisis of COVID-19 can kill companies. And those companies with sound balance sheet will survive. They were strong before the crisis and they will be stronger thereafter. If I start my presentation by looking at the space of European small and mid caps in the last 5 years, we've had years of great outperformance in 2015, 2016, and 2017. Years where in a low growth and low interest environment, small caps managed to show a defensiveness because they were growing fast and they were attracting higher multiples. This ended in 2018 and we had a strong reset of the relative outperformance of small and mid caps. They suffered a lot and in 19 rebounded and made a very solid comeback after 2 years of rolling underperformance, like you can see on the orange bars at the bottom of the chart. But were caught again in this derating led by the COVID-19 crisis. We believe that the long-term trend of small cap companies able to outperform in an environment of pedestrian top-line growth, pedestrian GDP growth is now more true than ever. They have very strong balance sheets. They dislike leverage. You will find that the average net debt to EBITDA is much lower in the small and mid cap space compared to the large cap, both in Europe and in the US. They are strong in their niches and they can grow. And we think that balance sheet strength and defensiveness in terms of growth will be rewarded and you will see higher multiples for this space going forward. Another chart which looks at the same thing, comparing the MSCI Europe Small X UK as an index compared to the Euro Stoxx 50 and the healthcare space in Europe. And you'll see that the healthcare space has had a spectacular outperformance in 2019 and also now in the COVID crisis. It is absolutely the sector the most immune to the crisis and has re-rated a lot. So that's the this index is not yet at the high of February 2020, but pretty close to it. And on the contrary, the small and mid-cap space is a lot lower and has further to go. Should we have a phase of normalization in this COVID-19 crisis where society can reopen again slowly, there will be no jump start, no quick recovery. But if we can put this crisis to bed and have a phase of stabilization, I think European small and mid caps can prove their resilience in terms of growth and financial strength. What have we done in the fund? The management principles are as true, even more true today than they have been in the past 10 years. Quality first. It's not a time for compromise in terms of indebtedness, in terms of the strength of the companies. As I said, houses that were in order before the crisis will emerge as winners, and weak companies are now significantly weaker. We focus on cash flow generation and the propensity to generate cash flow. We've gone through phases one, which was the shock, where the market fell like a stone. We went very defensive with a higher cash quote, and we're busy listing new ideas and establishing a watch list. Now we are in phase two, checks and balances. We have very intensive calls with managements every day of the week. And the three of us, Michel, Laurent, and myself, have 2 to 4 company talks 4 out of 5 working days. And it's very important to use your network, and we have a very good network. And it's not just what they say, is how company talk to you. And you can hear out between the lines if they feel comfortable, if they think their measures and action plans will help, if they think their business model is at risk. And it's very useful to be able to contact the CEOs and CFOs of those companies we've been following for many, many years. And the point of interest at the present time is how will demand develop in this situation? Do we see COVID-related demand peaks? Will they disappear when the situation of infection stabilizes? How, for those more cyclical companies that have shut down their businesses or have had no demand or less demand because of quarantines, how will they recoup their revenues in Q3, Q4, but also next year? How long will it take for them to recover completely? And there's a great divergence between the sectors and between the companies. And here again, it's important to have a good grips on the niche where the company is present. It's important to differentiate. And I would expect such a situation to be more prolific for active fund managers. And I think as clients, it's time for you to ask for an outperformance with an active stock picking strategy. And it's a chance for us to do better than the indices. I brought a few examples of companies we like, of companies that have been resilient in the crisis and we think will be resilient after the crisis. One example is S&T. It's a tech company based in Austria, listed in Frankfurt. It's a company specializing in IoT. It's actually a bunch of engineers, a bunch of nerds. And the CEO is very much invested in his own company as well, and is a shareholder. IoT is a theme which is not disappearing in the crisis. Everything is connected, everything is going to be connected. And what we like with S&T is that they have a broad span of verticals. They offer solutions for Industry 4.0, but for transportation, both divisions or sectors which are now much less strong in the crisis, but also for medical, for smart metering, and for the communication sectors, which have proven to be very resilient. So even in the face, the company has an ambition to grow its top line by 10% per year and increase margins every year. And we've been quite impressed with the fact that the company not only really has a guidance and communicates a guidance, which is very, most companies today, not only do they cancel dividends and buybacks, but they restrain from any type of guidance for 2020. Now S&T expects to be able to show revenue growth of 0 to 2% this year. They have 40% recurring income, as the installed basis of computers and robots they have installed everywhere is growing year after year. We think the company with a P of 17 for 2022 has the potential to re-rate further, and we are holding on and very happy with this position. If I continue, a new position we have in the fund is the German micro battery expert Varta, actually a brand which has existed since 1887. The Varta is specialized in tiny batteries, which you will find in hearing aids, but also quite normal batteries, which you would use in a normal household. I'm sure you know the brands of these green batteries. And actually, the traditional batteries are 50% of their business. We like that business because it's not capital intense, and it grows like GDP, but it grows. It's very defensive, and it generates a huge amount of cash. Cash they use to invest in new capacities for rechargeable batteries, for miniature batteries like the ones you would have in your earpods from different brands. The white one being the most the biggest growth brand, where they landed a huge deal with Apple, providing batteries. Now the stock lost 60% between December 19 and March, and there were two crises. One was in a tear-up, like you have a picture of an iPod being opened. Someone found Chinese batteries in Apple device, which prompted a very quick derating, as the company had really grown from success to success, with EBITDA margins of 26% and an exclusive position in this type of battery devices. Now, reality, we think, was that companies wanted to push out their products before Christmas for them to be ready in the shelves for us consumers to buy. And because batteries is a bottleneck, they went to other suppliers like Samsung and others. It's always a battle of market shares, but we think the space is so big, and we carry wearables, hearables without wireless. We need very high performing batteries, and the space growth is so large that there's ample place for different players. Now Varta has the best technology, the better energy density, the biggest quality and availability. We think those are great USPs, and we think that the growth of the company is secure. We like this barbell exposition to hearing aids. Batteries for hearing aids, 90% are one-time batteries. You need to change them every 5 days. Rechargeable batteries have now a penetration from only of 5 to 10%, but those would be batteries which have a much higher price and command higher margins for Varta, a very interesting business. And as you know, hearing loss is a factor of demography. We all grow older, and our ears are less good, and we need those hearing aids for a longer time. So with a P of 23 times 2022 for a very strong growth company, we think this is an interesting time to step in to a stock which derated a lot. A long-term darling of ours is Invisio. Invisio is also in the space of a hearing aid, but it's hearing aid for soldiers and policemen. It's hearing aid for the professional use in noisy environments where the ability to hear and communicate loud and clear is mission critical. Invisio was founded in 1999. It developed a technology of headsets based on bone conduction technology, and first wanted to commercialize these for the consumer and the professional market, but realized quite soon that they were tiny and had no chance compared to the big white competitor. So they concentrated on the professional market, where they are. The great thing is it's a winner takes it all type of market. Once you qualify, and it's a long period of time of testing, which can take many months, a year nearly. But then it's those are multi-year contracts, and you increase penetration. You go from one special force to the other. You go from one police town to the other. And we estimate that only 9% of the professional potential users have had access to the Invisio technology yet. And it's a technology which hinders hearing loss, which is a great cost for society and for governments, with the soldiers losing their hearing ability in wartime and in critical situations. We expect, we've been talking to the company on a regular basis. I think they are now reaping the efforts of their investments, both in terms of salespeople and technology, with a second device coming out where they had the first 2 orders in the last Q1. And we think this company can grow top line above 20% for the next 3 years at least, with a very strong return on investment, on invested capital, since it's an assembler. All their production lines in Germany and Sweden, they are mission critical as well, were never shut down. And we think that 2020 can be a great year for Invisio, and we see no influence of COVID-19 at the present time. And we have been rebuying into the stock lately, as it's 23% below its high of February, which we think is too cheap for the growth it provides. Arjo, just a comment on a stock we've liked for a long time. Arjo is a healthcare service provider for devices for the long-term care, mainly, where they concentrate, but it's also one of the biggest hospital bed provider internationally, together with some US competitors. It is a hedge, and this operation is a hedge for them in the COVID-19. The difficulty is, of course, that it's difficult for any med tech or healthcare service company to penetrate hospitals and long-term care units like elderly care with products and services that are not related to COVID-19 at the present time, since all protocols and capacities are really dedicated to win against the crisis of COVID-19. But on the other hand, their bed business, which they rent and sell, is exploding. So their order intake has improved massively. They have increased capacity. and this is an excellent hedge for them in this year 2020. More than this, we think that the company has interesting proposal in the medtech area with a product called Wand Express, which they have started to commercialize in the UK and in Scandinavia. And the latest tests have shown that the addressable market is maybe even bigger than they think. And we think that with this particular application and very high priced and high margin device, we think that they can re-rate in the regions and to come closer to the regions of the classical medtech companies, which enjoy very high multiples because of their growth and visibility. So RU is definitely one we are holding on to. Now, if I come to speak about the performance of the Europe Small in this year, you see that year to date, we did very well in the downside, with a relative outperformance of more than 5%. We've been a little bit behind in the rebound, as the portfolio was a little bit too defensive maybe, and we're a bit astonished, I guess, like many other players, by the strength of the rebound. With a very broad, diversified portfolio concentrating on tech and healthcare, we think we can catch up. And if you see on the next slide, the idea is really to repair the performance after the difficult year of 2018 for us, where we lost a big relative performance in the second half of the year, and to heal the 3-year performance and to close the gap to the index. We've been in the first quarter this year in the down until March, April, and now in the second quartile, but we definitely want to be back on the top of the performance league, and are very active in trying to find the right investment ideas for this volatile environment. If you look at our top 10 positions at the end of April 2020, you'll see a lot of IT companies, you'll see healthcare companies. Stocks like Rovi, Ario did really well for us, up 7 or 4% this year in a market which is very much down. But also semiconductors like ASM International are up 6% year to date, and after a very good 19, they are also they carry on outperforming as companies, IT companies invest a lot in semi and in new technologies and capacities. S&T I just talked about is up 9% year to date, but the best performer is certainly Swissquote, a financial online platform for financial services, which is up 36%. Another financial, digital platform we like is Zur Rose, the Swiss online pharmacy, which is #1 in the markets of Germany and Switzerland, which is up 31% since we bought it late January. And this was one of the ideas we generated. How can we, what stocks could benefit out of COVID-19? And certainly the switch from offline to online consumption of medicine has been boosted by the effects of COVID-19 and our need to stay at home. On the cyclical side, there's light and shadow. We've been very happy with Vidrala, the Spanish glass company, which has been able to outperform the benchmark, and it's been really very resilient in the crisis, with fantastic margin and the potential for further margin improvement. excuse me. Two stocks we're less happy with is Soprasteria and CAF. CAF is a Spanish train manufacturer and tram and uh, at 40% discount to its competitor Stadler Rail in Switzerland. We think the discount is undeserved, but we also think that their communication strategy is terrible. And we have taken them off the top 10 list despite this huge discount. After they have decided to postpone Q1 results and will publish Q1 together with its Q2 in July. I think this time is a time where you need to address the market. You need to be to take this adverse situation and speak about it. And I think that mismanaging communication is actually unexcusable in this actual situation. So Praseria we like. We've been dicing and slicing the company. Laurent Picard, who's our tech analyst and very good in picking the likes of ASM International and SAT, thinks the company is now very cheap. It's been down 40% more or less since February. And we think that it has a big chunk of their business, which is recurring income. So we think that they will prove to be more resilient than what the stock price says. I wanted to make sure you know and understand that our exposure in tech and healthcare related stocks is quite big. It's more than 50% of the fund. We have a third of the fund in tech and tech related companies. We have nearly 20% of the fund in healthcare and healthcare related companies. If you could look at the list, Ario Rovi we talked about. Galenica is an offline pharmacy company in Switzerland. And Zur Rose is the online version for Germany and Switzerland. MIPS is a helmet technology provider. You could argue is it a tech company or is it a a healthcare company? It's probably a consumer company with the ambition to protect our brains when we fall from our bikes or skis. And it's a stock which has been doing really well. It's up 36% year to date. Vitrolife addresses the problems of fertility. I'm sure you know 1 in 5 couples are infertile and cannot have children. And in markets like China, this is a big focus and a huge growth potential for them. Virbac concentrates on animal vaccines, both animals we every now and then eat, like cows or pets, and this has proven to be a very resilient market also in the face of COVID-19. Our tech exposure is broad-based. You have servicing companies like Atea, SoftwareOne, Soprasteria. You have semiconductor-related companies, ASM, we talked about, VAT and Vicon in Switzerland. IoT companies, SMT. We have devices company like Invisio, Azatec, the liquid cooling specialist from Denmark is up 52% year to date and has finally landed its biggest order in history for water-cooled data centers. And it seems like the green agenda of the European Union is solid and there to stay even after COVID-19. Vata we talked about. Then we have industrials companies with tech exposure like Hubensuner and Lem. And then finally, digital platforms like Swissquote, Scout24, which is dealing with a #1 real estate platform in Germany, and Ferratum. To finish off, I would come back to my title, Strong Balance Sheet is the Best Medicine. And you see that the portfolio as of April 30 with a net debt to EBITDA of nearly 0, meaning that we have many companies which are net cash. They are able to invest. They are able to continue to invest behind their growth strategy. And 2020 will be a difficult year for everyone, but they will merge out of the crisis, emerge as being stronger, gaining market share, and stronger in the niche they occupy. With this, I hope this finds you in good health, and I'm looking forward to update you again in the next future.
Thank you very much indeed, Birgit, for those very interesting insights. Also, to you, ladies and gentlemen, we would like to thank you for your trust in Bellevue Asset Management during this demanding period. We are happy to be at your disposal. In case of any questions or feedback, we are looking forward to continuously interact with you. Take care and stay safe, your Bellevue team.